moving into Mod 23, standard cost and variance analysis. Our learning objectives here are first to look at what we mean by responsibility accounting, then look at performance reporting using a static versus a flex budget, and that carries on things we've been doing all during the managerial accounting section of showing the importance of separating variable and fixed costs. Then we'll do standard cost variances for materials and standard cost variances for labor. First, on responsibility accounting, it emphasizes factors that are controllable by the managers. This usually looks at the comparisons of actual results in dollars to what they budgeted, since they created the budgets. And we customize the activities of each organizational unit or value chain so that we can show responsibility and authority and therefore have reporting follow. And we should, as a matter of good practice, exclude non-controllable costs because the manager gets that statement, and if they are looking at the costs for the department, it has a bunch of costs that are not controllable by that manager, there would be some dispute. You ask me to manage a budget I don't control. That's why it's always good practice and avoids a lot of conflict if the accounting department always remembers to only show the managers the costs that the manager had a hand in budgeting and also a hand in authorizing. So the org structure usually tells us a lot. It tells about the reporting lines, the areas of responsibility. There are different ways to organize a company. One are functional based, such as marketing or production or research. Second is product based, consumer product, industrial product, or services. Third would be geographic, the North and South America, Europe and Latin America, Asia. And service-based, it would be the types of services such as consulting services, tax services, and assurance services. Or customer-based, it's the national accounts, the government account, and the retail accounts. So there are many ways to do it. Each has merits, of course, and it's an important decision made by senior management. Responsibility centers start at the bottom, with the most important being investment centers. Investment centers kind of have it all. They have dollars invested, they have profit and loss responsibilities, so we can measure the return on investment for that particular department or project. Moving up from there would be a profit center, where they manage the revenue expenses, but the investment is a separate decision. Third would be a revenue center. Revenue centers are accountable for revenues but no costs. Finally, there's the cost center, where they have costs but no revenues. So let me give you some examples of what might be in each of these. Starting at the cost center, something like the accounting department or the insurance department or the HR department. These are cost centers. There are managers there. They manage a budget, but there is no revenue. A revenue center would be like a call center trying to solicit insurance purchases over the phone. They have revenues, but no costs to deliver the product. They have costs for running their call center, but not for delivery of the product. Next would be a profit center. One example would be a store. A store would have revenues and expenses so they can show profit. And then investment center might be a collection of all the stores for the retail operation, and they would be accountable for delivering return to the company for their investment in the retail stores.